Hello, this is John Cavalli of JK Financial, and this is your April 2014 Capital Market and Economic Review. And we're continuing to change up audio and video a little bit to try and get you a better picture. We hope you enjoy. We've got an exciting post that this video will go on. So let's get started, and I want to thank everybody for watching the videos. We've had great response, and we've had a lot of fun doing them. So here we go. Thanks so much. All right, so here's the post, the April 2014 Financial Planning and Economic Capital Market video post. This came out of, or this idea came out of the tax seasons, which was really tough this year. And what I wanted to point out to folks, since we've gotten through tax season, and those that have potentially filed a extension, is we all get it. As long as we're filing a Schedule A, you receive a sales tax deduction, unless it's phased out. There are certain situations it's phased out, but let's ignore that for now. And we have two options. Number one, let's call it itemized. Number two is take the standard sales tax deduction. The standard sales tax deduction with the IRS, as I pick up here on the IRS form, is based on your income, zip code, and your exemptions. And most of the time, as I say, most of the time it makes sense to go ahead and take your standard sales tax deduction. However, if you had a big purchase, which could be a car, a boat, an aircraft, a leased vehicle. I picked this up off of various different informational places here. If we had a substantial renovation in our home, which we paid some large taxes, or we had a large purchase that could have generated some sort of high sales tax, it might be worth plugging that in. Here's the deal. If we get, say, $7,000 as our standard sales tax, I'm just making this number up, and you plug in your sales tax numbers and it's 7,001, then it's you gained $1. And I'm saying that to just say if you immediately find that you have enough to get you over the threshold of the standard, then you can go back and search for all the other, like for example, all your credit card expenses, all your expenses that you can get your hand on. But it's worth a look, and I thought this, coming off of such a tough tax season, it might be worth a look. All right, we just can't get over this, and this is, I had recently I was with a group of folks, and we were talking about what the most important item is in telling the markets, and I asked them, would it be the Dow? Because the Dow's, we look at the S&P, the Dow is more noticeable and more noted. The Dow, interest rates are gold. It's interest rates. This interest rate, and this is at a 2.6. Interest rates continue to befuddle most advisors, most professional investors, including ourselves. This rate has even fallen down a little bit more. We've left our voodoo trend line on here. We're really closely watching this, and we don't understand it because Janet Yellen and the Fed actually pulled off another $10 billion. We started at $85 billion at the beginning of the year of QE purchases, and we're now down to 45. And that announcement was made late in April. So this is a big deal. These rates should be going up. We're not sure why they're going down. It could be Ukraine. It could be, we did have an interesting employment report just at the end of the month or the beginning of May. And while the headline number was good, if you dug deeper, it was not. These rates being low, which we'll talk about the possibilities, but all other things being equal, rates should be going up, and these rates being low could be signaling a slowdown. That's where we're watching it. That's why we're watching it. We hoped you enjoyed this, and we thank you once again for taking time. Thank you very much.